Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thanks to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time on this channel, it's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks in growing companies with positive cash flow that covers the dividend, in companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the stocks within the portfolio on a weekly basis. I also do large purchases as well if I have extra funds. I cover all my investments into this portfolio on my Sunday morning updates, any options that I've entered into for the week, any buys, any sells, any activity overall, dividends paid out, all that is covered. I do not have a paid Patreon account, so it's free to see what I'm doing. We all have enough to pay for, and I really just want to help people out and see that you don't have to be a financial guru or have a degree in finance to be able to do this. I grew up in a double wide trailer. If I can do it, anyone can do it. And I just want to show you how a real stock portfolio, dividend growth portfolio in my case, is built out on a weekly basis. And hopefully it shows you that it's not as difficult as you might think, and it inspires to some people to start their own investing journey as well. If you would like to help the channel, hitting that like button, the thumbs up button down below really does help out. Dropping a comment and let me know what you think of the videos. Most importantly, subscribe to the channel. Join us here on this journey to financial freedom. Join the Vested Interest community. We are building a community of like-minded dividend growth investors so we can share our experiences. Stocks like this that we're looking at to buy, that's what this particular video will be about. 4 stocks that I'm looking at for August. Verizon, 4 stocks I'm looking for in August: Verizon, Pfizer, NextEra Energy, and Enbridge. A couple of these we were looking at last month as well, Pfizer and NextEra Energy. We did recently start a position in NextEra Energy. We will see all that here in a minute, and we'll cover these stocks. And hit that notification bell as well so you're notified whenever we drop any new content. Now let's jump into the video and take a look at these 4 companies that may be worth adding to your portfolio over the next month. So this is the Vested Interest Stock Screener. This is how I set up my Stock Pick of the Day series. I do that Monday through Thursday. This is also how, on a high level, I look at a company to see whether, if it's not in my portfolio, whether I'm interested in adding it, or if it is already in my portfolio, whether I'm interested in continuing to add to the position, or if it's time to sell, right? You want to have some sort of criteria so that you know what your investing criteria is, what your goals are, what you're looking for, so you can make sure the stocks that you're looking at meet that criteria. And when they don't, it may be time to go ahead and sell them. But if you don't have that criteria written down or something to go by, you're just throwing darts, not really with any purpose or plan. Have a plan and then stick to the plan. That's the idea. You can pause this and go through this. For overall, must meet 4 of the 7 above if it's not a financial company. If it is a financial company, I throw in price to book as another one, so it must meet 5 of 8. But again, you can pause that and read through that, and you'll see here how I set up the videos to kind of follow this. And like I said, it's also how I set up the videos for my Stock Pick of the Day series. Let's jump into the first one here. Number 1 on the list, NextEra Energy. This is one we looked at last month as well. Ticker NEE. This is a utility company out of the utility sector. We did all these snapshots at about 3:30, 3:40 on Friday afternoon. So this is all current as of about that time on July 28th. So $73.06. I don't know exactly where it'll close the day out, but probably pretty close there. And they have a 52-week range here, $69.64, as high as $91.35. So it is closer to its 52-week low, though I would not mind if it continued to drop back into the high 60s here, or a little lower than it is. As I'm adding to a position, I don't mind it dropping down so that I can continue to decrease my cost basis and increase my position overall, increase my future yield and future returns. So Yahoo Finance estimates that this is a little overvalued. Negative 7% return if you bought it here is what they're saying. I don't necessarily agree with that, but that's what that means here. They have a market cap here of $147.868 billion, a beta of 0.46, so it is less volatile than the overall market. Price to earnings PE ratio of 18.04. That's less than the overall market right now. Earnings per share, nice earnings per share here, $4.05 per share. Next earnings date coming up sometime between October 26th and October 30th. The forward dividend is $1.87. This is a quarterly payer. So just divide that by 4, and that'll give you the quarterly payout per share. And it has a nice dividend yield of 2.55%. Ex-dividend date, the last one was May 26. It looks like it paid out in June, so if you were to buy them now, you would be in line for the next dividend. I think that June, July, August, somewhere in October will be the next one. And according to Yahoo Finance, they have a 1-year target of $90.75. So it does speak to some upside appreciation in the stock price here, right? Now, some other things, if you're a trader, this makes sense to look at. I don't really pay attention to this. They say it has a bearish pattern. You know, short term, they see it going up. Mid-term, they see it going up. Long term, I don't really pay attention to this. This is the patterns, chart patterns. That's more for, you know, day traders or swing traders. I'm not that. I'm a long-term investor, so I'm buying whenever the price looks fair to me, and then I'm holding for the long term. You know, unless it no longer meets my criteria and the company goes through some hardship or changes their outlook or something like that, or gets in financial trouble, then I will reevaluate. But for the most part, I'm a buy hold for, you know, the next decade plus. Now, some other stuff I like to look at, dividend yield theory. You'll go over here and look at their 5-year dividend average, 2.11. You compare it to their current 2.55% or their forward annual over here. You'll find this information under statistics down under dividend splits. And what you're looking for is the 5-year average below their current, which it is. So this speaks to some undervaluation, at least according to dividend yield theory. They have a low payout ratio, only 44.07%. So basically what that means is the company has a lot of room to continue to increasing this dividend over time. Also has money to reinvest into the company, pay down debt, make any acquisitions, and obviously pay out dividends, which is what you want. You want a lot of room for runway. I like 75% or less payout ratio, and it's not a deal breaker if it's over 75%. That's just what I look at for most stocks. As I said, the ex-dividend date was May 26th. They paid out on June 15th, so you would be in line for the next dividend if you bought them now. Now, you want growing free cash flow over time because they pay the dividends out of free cash flow. I will say utilities never look good in free cash flow, but let's go ahead and take a look. 2019, negative 2.9 billion, not good. 2020 at 224 million, you know, in the positive, but then right back into the negative again. 2021, negative 277 million. 2022, negative 1.4 billion. Utilities are just very capital intensive. It's not a good metric to look at free cash flow for these, but it is something to keep in mind. I would pay more attention to the payout ratio here for this one than I would free cash flow. Another one I like to look at, return on equity and return on invested capital. I like 10% or better for both. Return on equity is sitting at 19.60, so that meets my criteria. Return on invested capital does not at 6%, so mixed bag there. Though not terribly low for return on invested capital, 6% isn't the worst I've seen. And I do own NextEra Energy. Again, I recently opened or started this position here over the last month, so I have 14 shares. My cost base is $72.89. I'm slightly up, 0.24%. Not a huge run up, but I would like it to stay low right here in the 72, 73, or even lower. As I add to this, I'd like to get well over 100 shares. I'm going to nibble at this one 7-10 shares a week until I get to 100 shares, so long as it stays below the cost basis that I've set. And 15% of it's 52-week low, which is 69.64. So 73, I think it's like 76, 77, somewhere in there. I'd be comfortable continuing to buy this, but really would like it to stay low here. They do have a dividend coming up. That's what that D means. Next up on the list, Pfizer. This is another one we looked at last week. Ticker PFE. This is out of the healthcare sector. And same thing at about 330, 340. Whenever I took this snipping, it was $36.15 per share. 52-week range as low as $35.35, as high as $54.93. You're going to notice a theme here. All of these companies are right up against or very close to their 52-week low here. This one is right up against it at $36.15. They estimate a 3% return here, so this one's right near fair value, at least again according to them. Take that with a grain of salt, do your own valuation metrics, but they estimate it's pretty close to fair value. You'd get about a 3% return buying at this price right now. Market cap of $204.05 billion, beta of 0.55. That's another thing you're going to notice. A lot of these have low beta, right? So that means they're low volatility. I do like the lower volatility. Price to earnings PE ratio is very low on this one, 7.13. $7.13 per share. Earnings per share, EPS is nice, $5.07 per share. Earnings date coming up August 1st, 2023. For dividend, $1.64. Again, divide by 4. It is a quarterly payer. Very nice dividend yield on this one. You're going to notice on the next few, very high dividend yield on the rest of them. 4.46% here. So this is a income play, not only an income play, but a bit of a value play here as well. Ex-dividend date was July 27th, so we just passed that one. They're going to pay out September 5th. And according to Yahoo Finance, again, $41.56. So speaks to some upside appreciation for the stock price here over the next year. Same thing, if you're a trader, you'll pay attention to this. I do not pay attention to this. It says they're going to go down in the short term, mid-term they'll go back up, long-term they might come back down. I'm not a trader, so I don't really pay attention to these, price crosses, moving average, and all that other stuff that some traders pay attention to. Now, want to look at dividend yield theory again, you'll find it under statistics, right? Go down to dividend and splits, look at their 5-year average, 3.63. Compare it to their current 4.46, or over here forward 4.46, same number. And this number is much higher than the 3.63. So this speaks to, again, some undervaluation, at least according to dividend yield theory. And another one, very low payout ratio, 31.76%. Free cash flow we're going to look at again, because you want growing free cash flow, so you have growing dividends over time. This one looks a lot better, for a biopharmaceutical company, which is what Pfizer is. 2019, $9.9 billion, 2020, $11.6, 2021, $29.86. Now, this is the big jump up from COVID, right? So probably not sustainable, which you can see 2021 to 2022 drop back down, that boost that they got up. You're seeing that wane a little bit at $26 billion. So this may even level off further into 2023. But overall, growing free cash flow, which is, again, what we want to see over time. Again, let's look at financial efficiency, return on invested capital, and return on equity, ROE, return on equity, ROIC, return on invested capital. I like 10% or better, and this one's, it really smokes both of them. Return on equity, 30.90%. Return on invested capital, 31%. Very nice numbers here overall. And again, long Pfizer. I'm long on all these positions here that I'm going to show you today. So these are stocks that I own that I'm looking to continue to add to over the next month. Now, I am down a little bit on Pfizer. My cost basis is $38.34, so I'm down 5.71%. And so I don't mind continuing to add to this, and again, decreasing my cost basis, increasing my yield, and increasing my future returns. Next up, number 3 on the list, probably going to be a little controversial on this one, Verizon. That's right, I am looking at Verizon. I know a lot of people are running for the hills on this one, but I will tell you, when people are running away from a stock, this is usually whenever I am looking at it, because that's just Buffett's rule typically, right? Whenever people are greedy, you want to be fearful, and whenever people are fearful, you want to be greedy. So this is one I am looking at right now to continue to add over the next month. We are talking about Verizon Communications, ticker VZ, out of the communications sector. Again, as of about 3:30, 4 o'clock there on Friday, $34.10 per share. The 28th, Friday the 28th. And they have a 52-week range as low as $31.25, as high as $46.50. So another one that's pretty close to its 52-week low, though it was lower than this earlier in the week. I think it dropped down into the $33 range, which I was picking up some at that range. Would love it to stay down at 31 while I continue to build this one out as well. Fair value, they say it's right at fair value, 1% estimated return. Market cap of $143.335 billion. Another one, very low beta, 0.35%. And beta, if you're not aware, that's the market, right? 1 is the volatility of the market. Anything under 1 is less volatile. Anything over 1 is more volatile. Price to earnings, another one with a very low PE ratio, $6.82 per share. Nice earnings per share. EPS is sitting at $5 per share. Next earnings date is October 24th. For dividend, $2.61, divide by 4, another quarterly payer here, and a very, very high dividend yield. This is an income play right here, and if it's fair valued, it'd be a little bit of a value play as well. 7.78% dividend yield, very, very high dividend yield on this one. Ex-dividend date July 7th, and so we've already passed that. They're going to pay out on August 1st. So you would not be in line for this August 1st payment if you were to buy them now. And they have a 1-year target estimate of $36.40. So not a lot of growth here, but it is, slightly undervalued in potential appreciation in the stock price on this one. Same thing, if you're a trader, you might pay attention to this Williams percent R. I don't know what that means. Look that up and let me know down in the comments. If you're a trader, let me know what that means down in the comment section below. I'm not a day trader or a swing trader, so I'm not sure what that Williams percent R is down there. But let's look under statistics again. Dividend splits. We're going to look at dividend yield theory. 5-year average 4.84. Current 7.78. So again, according to dividend yield theory, speaks to some undervaluation at this one. Another one with a low payout ratio, 52.20%. So plenty of room to keep increasing this dividend over time, pay down debt, make acquisitions, buy back shares, whatever they want to do with the rest of that funds, but plenty of room to sustain this dividend on this one. That's why I'm not very concerned. I know a lot of other people are, like I said, running for the hills on this one. Let's look at the free cash flow. We want growing free cash flow over time. 2019, $16.9 billion. 2020, $21.4 billion. 2021, big drop, negative $28.3 billion. I think they paid down a bunch of debt here and had some reinvestments into the company on this one. You'd have to do some research exactly. But back into the positive in 2022, $10.4 billion. Overall, though, from 2019 to 2022, it is down a little bit on free cash flow. So worth taking a look at here. Again, this is an income play for some of you who may be younger, who have a longer time horizon. Maybe you want to stay away from this one. For me, I'm in my mid-40s. I'm looking for income so that I can retire and get out of the workforce. So this is an income play for me. Financial efficiency, again, we like 10% or better. This one does not meet these criteria. Return on equity is only at 4.88%. Return on invested capital is pretty low at 1.89%. I'm actually a little bit disappointed in these numbers, actually. But when I look at some other numbers like their margins, their estimated future revenue, and some of their growth numbers, I'm not as concerned. Very slow grower here, I'll be completely honest, but an income play nonetheless that I'm willing to pay for the 7.78% dividend yield. That's what I'm paying for. I'm paying for a return on my investment in the form of dividends. That's what I'm paying for. Now, I am down significantly in this one. I've been buying this. I was buying this in the $45 range. I'm down 19.23%. So another one that I'm continuing to add to bring down my cost basis and increase my yield. And even I'm not really looking for any price appreciation on this one as far as the return in the stock price. I am just looking for the dividend yield. So this one is only for investors, let me repeat, that are looking for cash flow. And that is the same for our last number 4, Enbridge. The last one on our list will be the same play as Verizon. People who are looking for an income play, right? You're looking to buy a return. That's really what you're doing here. You're not going to get a lot of appreciation in the stock price on this one. Talking about Enbridge, ticker ENB. This is out of the energy sector. And same deal as of about 3:40, 4 o'clock on Friday afternoon, July 28th, $36.39 per share. 52-week low was $35.02. So another one right up against its 52-week low. 52-week high, $45.21. They estimate about a 2% return here, right? So right about fair value. Market cap, $73.678 billion. This one has the highest beta of all of them, 0.90, still less volatile than the overall market, but it is up there at 0.90. PE ratio is very elevated on this one, $40.89 per share. EPS is not as nice as the rest of them, right? 89 cents on this one, so not as high as the $4 or $5 we were seeing on the other ones, $3, $4, or $5 we were seeing on the other ones, but 0.89 cents, it is what it is. Earnings date, August 4th, 2023 here, so that's coming up. Forward dividend is $2.62. Divide this by 4, again, another quarterly payer, another one with a very high dividend yield. Again, this is an income play. I'm not looking for a lot of price appreciation as far as the stock price goes. I am in this for the dividend yield, right? The dividend payout. Ex-dividend date, May 12th. They paid out here June 1st. So they paid out on June 1st. So you would be in line for the next dividend payout on this one. And a 1-year target estimate, at least according to Yahoo Finance, $45.11. So this one speaks to some upside on the price appreciation as far as the stock price goes. Now let's look at dividend yield. You'll find that again under statistics. 5-year average, 6.58. Current and forward dividend, 7.12. So another one undervalued, at least according to dividend yield theory. Now this one's going to maybe freak some people out here a little bit. Payout ratio, 293.86%. What am I doing even looking at this one? If you look at the history on this one, they are always in the 100 to 200 dividend payout ratio. So again, if you're not looking for an income play, this may not be for you. Some of you younger people who have a long time horizon who are not looking for an income play, avoid this one. If you don't like this company, just take it with a grain of salt and move on to the next one. I am buying the return. I'm looking for the dividend play here. That's what I'm looking for this one. This is an income play for me as an older investor, and I'm not that old. I'm only in my 40s, but I am getting closer to retirement, so that's what I'm looking here for. Now let's jump down under financials. You'll go to free cash flow. We want growing free cash flow over time. 2019, 3.7 billion. 2020, 4.1. So growing there, but then drop in 2021 from 4.1 billion down to 1.1. But then back up in 2022 to 6.4 billion. So overall, from 2019 to 2022, positive free cash flow growth, which is what you want to see. Let's look at return on invested capital and return on equity. Another one with low ROE, return on equity 3.9%, and another one with low return on invested capital 3.8%. This does not meet the 10% I like, but again, I'm in it for the dividend yield. I'm in it for the cash flow. That's what I'm looking for. This is an income play. And I am down on this one 5.9%. My cost base is $38.67 per share. So again, another one that I'm adding to bring down my cost basis and bring up my dividend yield. Well, that is it for this one. Let me know what you think. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Again, building a community of like-minded dividend growth investors so we can share our experiences. And it is different for each dividend investor or investor in general. If you're an income investor, if you're a growth investor, if you're a dividend growth investor like myself, where you are at in your investing journey and your life really matters. If you are younger and you have a longer time horizon, you might be interested in stocks with lower dividend yields and more growth potential, right? So growth potential in the yield as well as the stock price. If you're an older dividend investor like me, you're probably looking for more income plays. So I'm trying to provide a little bit for everyone, right? And find some things across the board that might work for you. The ones that don't work for you, just ignore them. Move on to the next one. Find something that does. Again, I'm in a different position in my life and position in my investing journey than you may be, and that's okay. We can all learn from each other. Eventually, you're going to be in your 40s if you're not already. So hopefully this will make sense someday. If it doesn't now, why are you chasing? It may look like I'm chasing yield. I don't feel I'm chasing yield. I feel these companies are safe. That's why I'm invested in them, or I wouldn't share them with you. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you'd like me to cover a stock in the Stock Pick of the Day series, for example, go ahead and drop it down below. And let me know what companies you're looking at for August. What are you investing in? What are you looking at? There are a couple other ones I think that right now are worth taking a look at. Kraft Heinz is one. Nutrient is one. CVS is another one. So there's some other companies that are showing some value as well, but the last couple weeks, stocks have really recovered, so it is getting harder to find value in that, and that is part of the investing journey as well, and part of this channel, sharing our experiences, what we're looking at, and stocks to look at. So if you have some suggestions for stocks you feel are undervalued, go ahead and drop them down in the comment section below as well. Let's help each other out as investors. You can't benefit, and I can't benefit from your investing. You can't benefit from my investing, but we can benefit from each other's experiences and sharing those experiences in the comment section below. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You money and should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.